is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Hi, Kyle. Thanks for joining.
Hey, Hall. Good. How are you?
Good. Yeah. Looking forward to catching up. Looks like you're doing some cool things there with Wild Way.
Yeah. Thanks for reaching out.
Yeah, you bet. Yeah. Well, we did a lot with consumer product goods here in Austin. We started an accelerator called SKU back in 2013 to 15 and been working with a lot of it ever since. Changed a little bit the dynamics of it. Used to be about building brands. Today it's more about ranking on the D2C networks like Amazon and Walmart and those things. But what are you finding out there?
Cool. So we were a SKU company years ago.
Oh, wow. Great.
Track number 4.
Oh, I was there for the first 3, so I just missed you. I had to go back and work on my business, but I did the first 3 and then had to step back out.
Okay. Yeah. We were in the same track with the Siete gang. I guess it was before they were Siete and yeah, they're probably the most notable company from that track. But yeah, really cool program they've got together there. And yeah, it's definitely changed a lot over the years.
It is. So. The market's changed too a little bit. Back then it was all millennial brands taking over boomer brands and building a brand to get into Whole Foods and that type of thing. But all natural is new back then. Today it's everywhere. But back then it was kind of a new thing. But like I say, we were building brands with repackaging, remarketing, and repositioning to get into the major brick and mortars, get them into brokers, UNFI, KE, that type of thing. But anyway, it continues to grow for sure. So how are you finding the market these days?
Cool. Yeah, it's definitely changed a lot. This is our 12th year in business, so it's definitely changed a lot over the years. I mean, I think it's. I like to think it's gotten tougher, but maybe that's just me. But yeah, I mean, it's definitely had its challenges over the years. Supply chain's gotten a lot tougher. Growth has certainly gotten tougher as well, especially as we've gotten bigger and gotten into business longer. Yeah, and here we are. We've survived it and gotten through it, but yeah.
Cool. Cool. You're raising funding. How's that going? Is it kicked off or are you just still planning it?
Yeah, no, it's kicked off. Still really early stage for us now, but it's kicked off. And yeah, it's been an interesting process. Certainly not. I don't think it's the most fun process for anyone, but certainly an interesting process for us. And yeah, I think the structure that we're trying to raise under is a little different. So that's given us, I don't necessarily want to say challenges, but it's kind of put us, it's more narrowed down our focus, I think, for who the right person is to invest, and who not the right people are to invest. And so I think that's helped with a lot of conversations. It's helped narrow down our focus, really. And so, but yeah, still very early stage though. We kind of started in December, so odd timing around the holidays and whatnot. So I've kind of picked it back up a lot more lately, kind of mid-January, so on into now. So
okay. So you have preferred redeemable. How does that work? I see you get a 2x payback. When does that start?
Yeah, so really it's completely negotiable. The great thing about the redeemables. Yeah, so it's a 2x payback to investor. The payouts can start with the first quarter, or they can start in 6 months, they can start in a year. That's really negotiable based on the investor and when they want to start getting those payouts. But yeah, that's kind of a broad level, right? The 2x payback for investor until 75% of their shares are redeemed. They get to keep some. They get to keep 25% of the shares to participate in any upside should there be some. Shooting for a payback period of 5 to 7 years. So that's kind of what we've mapped out to give what we think is an aggressive enough IRR for that structure. Obviously, it's not venture return, but it's certainly not venture risk either. It's kind of what we're shooting for. So,
and what is the expected IRR on that 5 to 7?
Yeah, right now we're looking at like the low 20s. This is what we're looking at. Okay. Kind of low to mid 20s. Yeah. It's kind of how we mapped it out. Yeah.
Okay. That's a pretty sure thing, I would think, given your revenue, or is it?
Yeah. I mean, the point that, we've grown profitably most of the years in business. And so, the goal is to grow disciplined and sustainable and profitable throughout the next 5 to 7 years. And so that investment structure really just kind of hammers that home and ensures that that's how we grow. Obviously, that payback period is determined on how fast we grow, but that what we've mapped out is that 5 to 7 year period. We feel pretty good about that. Yeah.
Okay. And what percent of revenue are you pulling off to pay it back?
We're looking at 3% of revenue quarterly.
Okay, that's pretty good.
Yeah.
So I came up with something similar myself. I call it the 3X and 3. And it said at year 3, investor gets the right to require 3x their investment. 50K in is 150 out. Or
Okay.
they forego that and they go on the cap table for the original 50K. So if it's the next Facebook,
Okay.
and this is any company, not just CPG, but it's a very good fit for CPG because it can be a while before you get paid back, and venture is not necessarily the same thing as CPG, given the cost structure. You have to pay for all the product and so forth. It's not SaaS, type investment. It's different. And so had some good traction with it, good luck, and have some investors that do 3x and 3 investments that putting in money, and if they want to redeem, they can. And traditionally, redemptions were at year 5 for your original money back. But I got into it because I was having so many companies turn into lifestyle businesses, not CPG, but just everything else, that I wanted to, if they're going out on the payroll track, I wanted to go with them. They want to be on the equity track, well, happy to stay there with them as well. So I have done a number of those as well. So we have investors, angels mostly, that are doing these kind of things. So we could get you in front of people, even though yours is a slightly different model. It's basically the same thing. If you decide to redeem and they owe you 150, but they only pay you like 50, well, then we'll put the other 100 on a revenue share agreement around 2% of top line payback. And the goal was to try to get some of the cash back up front. So I was coaching the startup to escrow your principal so you can pay that back if they go, and then the rest go on a rev share agreement, which is mostly more 3 to 4 years, but it's 22, 23% IRR. It's not a huge difference really there.
Very cool. Yeah. So have you found that what are the biggest kind of reasons why investors would invest in that model or not? Yeah, I guess I'm just curious as to what makes someone, say, hey, this is, I want to do this versus like, hey, it's not for me.
Well, in the early stages, when there's not a lot of revenue there is still the risk that it could go under for startup failure. So you still have that risk on the table. If it's really a home run and it's really rocketing upwards, well, then we can always jump on the equity track side. In ours, it was fairly flexible. The last one, they basically said, well, I'm going to cash out. I'm going to do the full cash alternative. I'm going to take my 3X out, but I plan to put some money back in. So, it was one of those things where once you get the money back, I'll decide how much I want to put back in. My thesis was always take 50 out for myself, take 50 out for my next company to invest in, and leave 50 in for the investment. So I get some payback. I get to create an evergreen fund. I can do more of these deals. If I can keep getting my 3X every three years, that would work. And so there are people very interested in that. So they're looking for things that are, they can pay back at least 3X. And then if it's a home run, well, maybe I'll leave some money in for that. Because it could be equity will be a bigger payout if it hits, but so many don't hit. That's a challenge at the very early stage. So it's just the risk of early stage investment that holds people back. There was the issue of going through the process of redeeming and all that. We came up with a convertible note with a redemption right at year 3, gave you 30 days to make a decision. And we offered a facilities management program where we'd go through and what I found when I did revenue-based funding was I look at Lighter Capital and the other guys, because that's what we're getting into is revenue-based funding, is they get access to your QuickBooks and your bank account, and they start pulling the money out themselves. They're not waiting for you to get around to writing them a check. They're just, they're part of that process. They want operational control, not just legal control. And so if you're offering that kind of facilities management, we can help with that if you want. Then they have more comfort that there's somebody that's going to take care of all this, because they just don't want to go mess with the paperwork. They don't want to go mess with all that other stuff. And what I found with facilities management is they were, at least looking at Lighter Capital and the other ones who did it, was they're simply just watching the transactions go back and forth. So they know what's in the business, they know what's happening. If you know, then it's so much easier to discuss and plan how things go versus you don't know. And I will tell you that some of the companies that took us up, they would never share their financials with the investor. And that was frustrating because I'm owed that. You're supposed to give me that. But 3 years on, we're still arguing. You just haven't showed me that, because they know that once they know what's there, then the discussion gets to be very real. So a facilities management program, third party or whatever, might make this more easy to sell, because there's this accounting group. They're going to do this. They'll give you the reports. Here's who this is and here's how it works. And you don't have to go worry about, to go chase it. The reports just show up. And we had very strong information rights in ours. You got everything: income statement, balance sheet, the cash flow statements, all that stuff was there. And we also had very, very strong teeth once the redemption was made. We gave the investor consent rights over all cash disbursements after the decision was made. That means I'll call you tomorrow, let you know what your new salary is going to be. And so it really lands hard with people. But like I say, legal control is one thing, operational knowledge is the other. But a facilities management program is something that I found that's what all these revenue-based funding, that's what they have to do is they have to do operational management. They have to go in there and watch this stuff and maintain it and so forth. And the individual investor who's got a day job and 20 other investments really doesn't have time for that. So that's one angle to think about is how do you make that more efficient for the guys? And we offered a facilities management. We have accountants and bookkeepers. They'll log in, they'll look at the stuff, they'll write reports, they'll send it out. Because to be honest, the CEO really didn't have time either to do that. And so that's something that might help.
Cool. So walk me through like the process of like, working with you guys and how that looks and all that kind of stuff.
Well, if we're raising funding, what we're doing is we're investor relations introductions. We take your pitch deck, put in a warm introductory email, send it out to our network, build a list of initially interested people. And you get a lot of angels very interested in this. VCs, not so much. They really want a home run, and they wanted $3 to $5 million of revenue. You're really close to that, but I found there's just not a lot of VCs in the CPG space. There's some, but mostly it's angels and family offices. A lot of family offices. Some family offices did very well with CPG, and now this is what they do. So we're going primarily to the angels and the family offices, and we're saying, here's a great deal. We want you to learn more about it. And we share with you the results on a campaign worksheet. It's a spreadsheet. Here's all the investors that came in and what they do and what they did with it. Vast majority hit the follow button. They could hit the intro button, but they're usually not ready to jump on a call because they don't know what this is yet. The follow button means they just want to get the updates. And the pass button says, well, I'm not interested at all. So we take those guys off. And then we invite them to come hear you pitch in our online events. We do 5 of those a month, the Zoom calls. And then we've just launched 2 weeks ago in Austin, our first of a mini series of a hybrid roadshow event. It was in person. Had 25 investors in the room. We had 7 companies pitch. Everyone got at least 3 to 5 introductions and follow-up calls out of it because they're in the room talking to them about it.
Yeah.
It makes a big difference when you're pitching. And then we do in-person events. Zoom is a great way to open these dialogues, but it can be a hard way to close because there's no FOMO. Everybody's isolated. They don't know what others are doing. So we do dinner events, 10, 15 people gather. Here in Austin, we held it at the Austin Fix, the AW Marriott. We've held them in Seattle, the Bay Area, on our way to Philadelphia and Atlanta with it. And it's either a nice restaurant or a law firm office. A law firm office will give us the room for free, and we just cater it in with a decent meal. It's not steak, but it's close. That you can get people together to go through and answer everybody's questions, basically do due diligence. It works well with people that had seen the deal for a while, but they've not closed. And I talked to a lot of people that said they got 40, 50 investors that I pitched, but they never said yes or no, and I can't move them. What do I do? We just start doing dinner events in their areas where we can. We just go through and do the dinner event. You got 30 days closed, and then we're moving on. We're not going to hang around anymore. And so you make a deal with warrants and advisor shares, whatever, just to get it done. And we were getting 20, 25% close rates out of those, and those are doing really well. So that's basically our program. It's $3,000 per month for a 3-month commitment. And after that, it goes month to month. And if we were to do facilities management, it'd be a different structure because at least with ours, we were in there for 3 years, before they would have to do something. But at the same time, people kind of want to know how's it going. And we wanted to be able to tell them, here's what's going on in the bank account. Here's what's moving and what's not. We did encourage the company in our program to escrow the principal. If you raise $500K, make sure you escrow $500K to pay back at least the principal if required. And we were watching that. Are we really doing that? Or are we not? And that's one question people had. So that's how our program works. We're not a broker. There's no back end fee. If we do a dinner event, we have to charge for the food. Like I say, we were doing like $5,000 dinner events because restaurants, the nice ones are pricey, but we found we would get it for about half the price with a law firm office where they give you the room for free, but you cater in the food and not exactly Dom Perignon champagne, but it's decent food and drink for sure.
Very cool. Let me see what other questions they got for you. I know this was supposed to be quick, so I apologize if you have somewhere else. If you got to jump, let me know.
No, I'm free to the top of the hour, so happy to answer any of the questions you have here. And we can always jump on another call. I can send you more detail. I can send you an email about how we work and then a campaign proposal. And if you wanted to join, you just put in the first payment, and we'll next day have an onboarding call. The goal is to get the intro mailer out in 1 week. It's not hard. It's just, elevator pitch, deal highlights, team, and so forth. But there is a little bit of a gathering. You get the right photos and stuff to make it look good. Then you approve it, we mail it out. A week and a half later, we have the results. You start going to our online events, you watch them, then you pitch at them. So it's pretty easy to see how it works. And then we start going out to our hybrid event. Next one's March 21 in Seattle. We'll be in Dallas on April 11th. We'll be in the Bay Area the week of May 13th. We're scheduling that now. And then we'll be in Chicago June 6th. We'll be in LA downtown and then Orange County on third week of June. And then we're talking to other cities, Boston, New York, DC, and Raleigh and Houston to wrap up the year's tour. So at least one a month, although we are getting called to go to Colorado and other places. And it's just a pitch event, it's not hard to go put those together and we can get a good group together. We work with a lot of local angel groups. I find a lot of angels to be very interested in this deal because they're at heart, equally wanting a great return as well as capital preservation. VCs, unless it's a 10x home run, I can't even talk to you. So they're usually not interested in these things, but family offices are very interested in that as well. So we could get you, we do have a family office panel series we do once a month online, how to start a family office, how to run a family office, get a lot of high net worths coming into that could be interested in this as well. 20% is good. I found that was the rate at which if it falls below 20%, their eyes glaze over and they just can't get excited anymore. But if it's 20% above, they'll pay attention to it. So you got to be at the 20 and plus level for sure. So in your R, so I think you're okay there.
And that's 20% or more equity. Is that what you're?
No, 20% interest rate.
See,
the return's got to be at least 20% because it's at heart, it's at risk. And so they just, and then they do a lot of equity deals where it's, 2, 3, 5x returns. So this is in between and they like to do a little bit of it for the right deal. They like to do it. We got into a lot of deals where the entrepreneur had heartburn over the dilution. And so the idea was peel off 15% and do that on a revenue share agreement where you can pay that off if you cash flow it. And then you suffer less dilution. So and I found a lot of revenue-based funding worked well with that. There was a combination of debt/equity in the same deal. The equity's in there for the long haul, give you working capital. The revenue shares there to give you some income in the early days. So you're not just sitting on nothing for 5 years. You're getting something back. And we were starting ours at year 3. And I started mine at year 3 because that's when it became clear which way it was going to go. Where they're going on the payroll track or they're staying on the equity track. And so we kind of wanted to be there at that decision point to wherever they're going, that's where we're going. That's what CEOs always ask me, what are you going to do? I'm going to do what you're doing. If you're cash flowing this on a payroll check, I'm right there with you. I'll just call it a rev share. You're on the equity track, well, I'll stay with you as well. So it's pretty easy because they know where the money is. So I just follow the money.
So you're saying year 3 is when the redemption started, or that's when they can make the choice whether to redeem everything? Or...
Well, that's when you make the choice, and that's when it starts.
Okay. Cool.
Like I say, 2% of 100K top line, 2% of $1 million top line. It just scales where it just starts wherever it is and just scales with it.
And was that did you guys do in year 3? Was that a lump sum payment, or did that start redemptions over time?
Well, it was a negotiated agreement because you don't know where the company is. That's why I was coaching them, pay back the principal. But if they can't, you do need to be able to move to a rev share agreement. And at heart, the angel has to understand that you could require a debt instrument, but if it really hurts the business, you're not going to get paid back much faster. So it really has to be let's come together and make this work for everybody as much as we can. And you're not going to in most cases, you're not going to get all your money back in one go. Some you do, but most you'll be in that thing for 2 to 3 years. But you have a path out of it, and you'll get money out of it along the way. So it should be a decent deal for you. So you got something for your time and effort. Like a lot of deals with turn to lifestyle businesses, you don't get anything back. It doesn't go under, so you don't get a tax write-off. It doesn't rocket up, and they sell it. So here you don't get money. Those other ways, but here you're getting money back, and that's what investors wanted. I just want to get something back.
Cool. Yeah, I'd love to get more info from you if you could.
Cool. I'll send it over. Where did you get this model from?
So we're working with an advisor. His name is Elliot Began, and he's trying to champion some of these alternative structures, specifically in the CPG space. For exactly like you said, so many brands, especially CPG, they're not on the VC track to to boom and blow up, but but they all still need funding, especially on the impact, people that are kind of mission driven or on the impact side. Still doing a lot of great things, but they're not going to be, they're not going to return a massive return, but they can still return a decent return to investor with a model like this. So just trying to look for alternative models for CPG companies that can still be win-wins for both, funder and founder. So
Right. That makes sense. Yeah, that sounds cool. I need to check back in with the SKU guys, see if they're interested in this. I haven't talked to them in a while about it.
yeah,
We talked about doing syndication funds and so forth. How was the support after the program? Was it good, or could it be better, or what do you think?
certainly could be better, I think. Yeah, I think it certainly can be better. I mean, I tried to tap the SKU network with this raise. Didn't get a ton of interest, but I also don't know how well. I think it was just an email blast, right? So I don't know how well that was received, or if it was received, or if it went to, if it actually got to inboxes, or where it all went to. And so, yeah, I know that they have to be careful with what they can't, obviously they can't endorse anything and that kind of thing. So I know they're trying to be careful with that. But yeah, so I think there was a little bit of a disappointing response when we tried to tap the SKU network and larger SKU network with this current raise. And
It's interesting. I find new investors think, everything's going to be the next Facebook, but once you get into it and 3 years in, you are very, very, very happy to have a 3x return, because, and it's paying out now. They're very, very happy. So experienced investors will understand the value of it. Inexperienced will not. They just think everything's going to be a Facebook return, and it's not. So it's a different angle there for sure. And so anyway, once you get a track record going here, I think it'll be easier. I've got a couple of case studies we've written up on ours that we're going to start putting out and start marketing as well. But like I said, we can help you with this if you need help with it for sure.
very cool. Well, yeah, I'd love to get additional info and go from there. For sure.
Okay. Thanks so much for taking time. I'll let you get back to it.
Yeah. Thanks. I'll appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Halty Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.